In the last 6 months, the dollar has weakened against euro, losing almost 10% of its value. But what are the implications for European investors? When the euro strengthens, the value of our US assets drops in euro terms, even if those assets are rising in dollars. For example, today the S&P 500 is hitting all-time highs over 6,370 points. But the ETF tracking the same index has not yet recovered the value of 6 months ago. This does not apply only to equities. Assets like oil or commodities and even US Treasury bonds, all priced in dollars, also lose value in euro terms when the dollar weakens. Even safe havens like gold aren't immune. So while it might look like our US investments are doing great, currency movements can quietly erode our returns. Before we look at the countermeasures a typical investor can take, it's important to highlight the other side of the coin. Yes, a weaker dollar means the value of US assets drops in euro terms. But at the same time, a stronger euro gives you more buying power. You can now buy more shares of a US stock or ETF or more ounces of gold for the same amount of euros. So even if it looks like our portfolio is shrinking, this situation creates a unique market opportunity, the chance to invest in quality dollar-denominated assets at more favorable exchange rates. For example, if a US stock costs $100, with parity we'll buy it for €100. But if the exchange rate changes from 1 to 1.10, it will now cost us only €90.91. For long-term investors, that's a strategic advantage. If the euro and dollar return to parity in the future, the assets we bought today could gain significantly in value, not just from the market growth, but from the currency rebound as well. Now, what can European investors do when the dollar drops and currency risk hits your returns? Here are 3 smart strategies to consider and some trade-offs to keep in mind. Don't put all your eggs in one basket, especially not just in the US. Diversifying your portfolio across regions like Europe, emerging markets, and Asia can reduce your exposure to a single currency. This way, if the dollar weakens, you are not fully dependent on US performance and you benefit from growth in other parts of the world. Another option, use currency-hedged ETFs or funds, especially for US assets. These products are designed to cancel out the effect of exchange rate movements. It sounds great, but there's a catch. Hedging adds extra costs, which can eat into long-term returns. Also, hedges don't always perform perfectly, and over time the cost may outweigh the benefit unless you are dealing with high volatility or short-term exposure. For example, in this chart I am comparing the same ETF hedged and non-hedged. Right now, the hedged ETF is doing much better than the non-hedged version, but 6 months ago it was the other way around. Finally, just go beyond the stocks and bonds and think out of the box. Consider diversifying into non-dollar denominated assets like European real estate, maybe through investment trust or crowdfunding platform, peer-to-peer lending, or even cryptocurrencies like Bitcoin. Crypto can be seen as a currency-neutral asset, since it's global and decentralized. Bitcoin in particular is often seen as a currency-agnostic store of value, though of course it comes with its own volatility. Having a mix of uncorrelated assets can help smooth out the impact of currency swings. So while the falling dollar might feel like a setback, it's also a reminder. The more diversified we are across geographies, currencies, and asset classes, the better protected our portfolio is in the long run. Whether it's through currency-hedged ETFs, emerging markets, or even real estate and crypto, there are smart ways to protect our portfolio from currency swings. If you found this helpful, give it a thumb up and consider subscribing, and let me know in the comments below how you're reacting to the weaker dollar. Thanks for watching, see you in the next video. Bye!